Hi, good morning. As you all know, this series, Billionaire Investing, focus on how the billionaires think when it comes to investing, how they look at risk and returns, what's running in their mind when they look at asset allocation, and what is their definition of risk. Is this slightly different from the general risk that we talk about? So, my dear friends, today we have Jacob McDonough. He's the founder and portfolio manager at McDonough Investments. He works as an RIA and helps his clients build a small portfolio of stocks, very specialized across the world, which they feel is extremely undervalued and overlooked with a special interest in Japan. He has authored a very interesting book known as Capital Allocation, which illustrates uh, Warren Buffett's earlier style of investing and how it evolved over the years. So Jacob has spent a lot of time doing it. And my first question to you, Jacob, of course, we'll start with the book, which you have done such a tremendous work. And so why don't you spend some time? I know it's a book, large book. So why don't you spend some time on some of your key takeaways and discoveries on Warren Buffett's style of investing while you were writing this book?
Great. Yeah, thank you for the kind words and thanks for having me. I published the book in 2020. And so I guess this year in May will be 4 years since I self published a book. It was a lot of fun to put together. How it came about was I noticed in the present day, when someone writes a report on a potential investment or writes up why an investment would be good or bad, there's a lot of data, quite a bit of financial analysis, um, very detailed. And when I read history books on a business or an investment, it seems to be a little more in the storytelling structure. It seemed like two very different reads. And I love history, but I also love looking at investments in the present day. So I wanted to have a book that kind of bridged that gap, try to pretend I was living in, the 1950s, 1960s, in when Berkshire and Warren Buffett were just kind of starting out, and what could have an investor seen back in that time period? What maybe would that investor have written about just by looking at the public filings and things that were available back in that time? It's not going to be perfect because there's obviously some bias. I can look and see how successful Warren Buffett ended up being and how successful Berkshire ended up being. And if I was in the 1950s, I never would have guessed that. So you do have some biases, so it's not going to be perfect. Um, but it was a lot of fun to put together, a lot of fun to try and think through what an investor could have seen back in that time period. So, for listeners who don't know, my book covers the early history of Berkshire Hathaway, 10 years before Warren Buffett took over the company, and then it ends in 1985. That's when the original Berkshire Hathaway textile mill closed down. So, just seeing the transition in those first early years is what the book does. And what was really interesting to me is that Buffett, when he was taking over Berkshire, he had all his money basically in three businesses: Berkshire Hathaway, a textile mill, Blue Chip Stamps, which was a discount program for retailers, a trading stamp business, and Hochschild Kohn, diversified retailing is what they called it, but basically it was one retailer. And by 1985, the period my book ends, all three of those original businesses had failed. Basically, the textile mill was closed down, the trading stamp business basically went to zero, and the retailer they first started with, wouldn't have been in business anymore by then. So what blows my mind is how, today Berkshire, I think, just crossed the $1 trillion mark in assets on their balance sheet. How do you go from three failed businesses into what we know today? Even studying it, reading it, and writing about it still kind of blows my mind, and it's a fascinating story. And so I really want to get behind some of the details and where did cash come from? How did they generate cash from bad businesses? How did they, um, maneuver some of that cash into better businesses? And what did that look like year by year? And that's how the book came about.
Right, right. So would you like to highlight some very interesting examples from the book or some of the interesting styles what Buffett used, which is still valid in today's time, and
Yeah,
some of the
there's
mistakes probably he made?
yeah, yeah, there's a lot. And so maybe starting with mistakes, excuse me, there's not a ton of mistakes, honestly, that you see throughout that early time period. The one you could point to is maybe starting with businesses that were going to fail, is maybe the mistake. There was a few others where, you know, Buffett and Munger formed an entity called Diversified Retailing. Eventually, it merged into Berkshire Hathaway. Um, but when they started that company, their plan was to acquire a bunch of retailers. That's why they named it Diversified Retailing. They acquired two, and by the time they acquired their second one, they realized they'd made a mistake. So they ended up selling the first retailer they bought, put money into stocks like Berkshire Hathaway. Um, and so it ended up being not very diversified and not very much in retailing. And so my point there is anytime they kind of had a plan, realized maybe it wasn't the best plan, they very quickly would come to terms with that realization and try to backpedal and reverse course anytime they could. They were very opportunistic, and just because they started going down one path in terms of that diversified retailing story, or just because Warren Buffett bought into a textile mill, they were very willing to change course when they needed to. Um, and maybe just another example, more in the positive light, is when Warren Buffett took over as CEO of Berkshire in 1965. The first 2 years, they were actually pretty profitable. He was able to cut costs. The first couple of years, overhead costs were slashed, and Berkshire was actually able to generate some nice profits. And the company had some tax credits built up from losses in previous years, and so that was some tax-free income there. And so the first 2 years generating healthy cash flow helped him have liquidity, have cash to go make some acquisitions or invest in stocks, and that really built the groundwork for what he created over time. And so even though the textile mill was not um, a good business, he was able to get a little cash from that in the first couple of years through managing the business pretty well.
He could pivot very fast. I mean, he was not stuck on with loss-making business. He could pivot very fast, and he ensured that cash flow was always there, right? The
Yeah, that's
focus
right.
was, yeah. Okay. So, since you did a lot of work, I'm assuming that a part of the investing style of Buffett could have come to your investing style also, what you learned by looking at the financial statements and concept of margin of safety, etc. So, Jacob, would you like to throw some emphasis on how did your current investing style evolve over the last few years, and what challenges that you face on a regular basis when you are doing this style of investing because you're picking stocks in multi-geography? And what's your edge? How does it compensate for the risk that you take?
Yeah, so I'd say my style um, has come from learning from Warren Buffett. And he said this many times, but if he was starting over today, his advice would go to flip A to Z of every company name you can find. And that sounds very simple, but it's pretty difficult. It's much more tempting to follow, the news cycle, and follow, what companies are kind of making headlines and and looking like some hot stocks. Excuse me. Um, but if you go if you go A to Z, um, there's going to be a lot of companies you don't understand. There's going to be a lot of businesses that don't look too appealing to you, either because of the business quality or because of the valuation. But if you really aggressively are searching, from time to time, you'll find something that's interesting. So in terms of edge, I think it's being very, very patient to pull the trigger and make an investment, but being very aggressive searching until you just find a situation that, one, you can understand, and two, that is actually very attractive, very above average. And it's hard to find those situations, but they're always out there if you do enough searching and if you try to keep learning and try to understand businesses more and more. And so if you take that approach, I think you need to be you need to have a fairly concentrated portfolio. Again, that depends on your personality and your structure and your own needs. But um, I think that's what a young Buffett would do today. He would spend every day aggressively searching for ideas and then kind of concentrating on what he um, what he thinks is best. And it sounds simple, but doing the work itself is what can be, a little more difficult for people given the temptations of just following what's interesting in the latest news cycle.
In fact, the last interview I was seeing of Munger was telling that he hardly manages to do 3 to 4 balance sheets in a day. So
Yeah,
a
that's right.
person like a person like him, or Buffett, who's at maximum, they are able to do 3 to 4 balance sheets. I mean, for a normal layman, I think probably reading it probably would take few days properly, I would say.
Yeah, I
Isn't
think
it?
they spend a lot of time thinking, instead of just trying to quickly read through, maybe spending a lot of time, take your time and thinking through to try to make sure you deeply understand the situation instead of more of a casual surface level kind of thing.
In fact, Jacob, the new thing which has come nowadays is there's a concept known as screeners, where people are just looking at important metrics like return on capital employed or ROE, sales growth, profit growth. And it's very much prevalent in India also. I think people are doing that, and uh, they're probably using 3 to 4 minutes or 5 minutes just glancing through and getting a view of the company. But I think that doesn't work because you miss the fine lines, the notes, the fine lines, the statements, the talks of the promoters and the management.
Mhm.
So I think because of which people tend to invest in heavily overowned stocks in the country, which is making statements in the last 2, 3, 4 years. And they're not looking forward.
Mhm.
So, Jacob, how do you manage with multi geographies? You said with a special interest in Japan. Of course, Japan is moving now. It's a fantastic run over the last 1.5 years. But how do you maintain that the space is so large? So, can you tell us what's your style? How do you make sure that you only spend time in good companies? Is there any way that you follow?
Yeah, so the way I came to investing in Japan was through that A to Z mindset. I looked at a lot of companies in a lot of different countries,
Yeah.
and it just happened. It's not a macro point of view; it's more micro. Where as I went A to Z in Japan, I just had a list of far more companies that seemed interesting that I should do a deeper dive, deeper analysis on. Japan had a longer list of things that of companies that looked interesting to me versus say, um, the US. So it's not me trying to pick what country's going to be the best country going forward. I'm not smart enough to pick that. And there's plenty of great businesses in every country. In the U.S., there's plenty, and I know there's got to be plenty in India. And Japan's the same way. Japan's a very large country economically, so it's got a big economy, and there's a lot of businesses there. So you get a diverse range of businesses. There's good and bad, and you can find any type of business from very old industrials to very entrepreneurial tech companies too. So it's more so of a um, bottoms up A to Z mindset. And maybe one mistake or one thing I'm learning more and more is that you really have to understand the culture of that country, or at least its business culture. And I knew that going in, but the more I study Japan, the more maybe I'm learning. Um, just little differences that maybe you wouldn't notice right away, and I'm sure every country has that, and, so it really hammered home that, the more you study a country, the more you can learn how there's either maybe some differences with your home country, at least with
Would you
I
like to
felt that.
throw some example, Jacob? You mentioned about the culture and the style of management. How does
Mhm,
it affect the stock price, and how do you perceive it different than America,
mhm.
and
Yeah,
how things change?
mhm. Yeah, the thing that's on my mind in terms of culture, Japan today reminds me a lot of the time period my book covers. in the United States, the 1950s and 1960s, when I study investments back from that time period in the US. It reminds me a lot of what I see today in Japan. And so what that means is I find there's quite a bit of overcapitalized companies in Japan, ones that have quite a bit of cash or real estate or other assets compared to the valuation of the company. And that was at different times, like I mentioned in the 50s. In the US, that would be the same case over there too. And so sometimes those things change. And I noticed in Japan, um, maybe one cultural difference is companies seem to, at least in my opinion, seem to have a much more longer term focus, which is great. But they also, some companies have lower returns on equity because they keep more cash maybe than they need on the balance sheet, um, less leverage. And so with everything, there's some really great benefits to that. There's maybe some downsides. Some benefits would be, someone like Warren Buffett loves companies with a long-term focus. It's great to treat your suppliers well and your employees well and the community you're in. That's all great. And then, but for a business to really thrive long term, you need to have adequate returns on capital. You at least need to have decent returns, or else investors aren't going to want to build a new plant or invest for the future. So it is a balance. I find there's a lot of benefits to the culture of Japan. Um, at least for the majority of companies, but at the same time, I think some companies seem to be focusing on trying to improve their returns on equity. Um, at least it's good to keep some cash on hand, but maybe there's some companies that don't have to keep quite so much there. Um, and so, yeah, it's just a balancing act of, in the US, if a company's overcapitalized for too long and not earning its proper return on equity, you would probably have some sort of activists come in and try to change things. In Japan, you see a lot less shareholder activism, and especially compared to the US, at least, it's a very different activist landscape. So understanding that has been important, important mindset.
So looking at these companies, and of course, Japan have passed the previous high, what it has hit 30, 40 years back. And I was seeing a lot of capital allocation from China is moving to countries like India and Japan. And Japan has still a long way to go in terms of returns. Do you think with the current growth and inflation environments, Japan could be a longer term bull market?
Yeah, I would say what's interesting to me is the long-term effects certain market bubbles can have. I know Japan had a very large bubble. I believe it burst in the late 80s, 1980s, and
Yeah.
there's some hangover effects felt for a long time because it just takes time for that to correct itself, and then the correction means there's been poor returns in the recent past, and then maybe some investors avoid that country for a little while just because returns have been so bad. So it's um, both on the upside and the downside. Bubbles can have some really long-term effects on markets. And so I think that's one thing I guess I like to see about Japan is studying that history. And I think just because returns maybe were bad through the 90s, and there's a lost decade there, and that spilled over into the 2000s. It doesn't mean it'll be that way forever. And so the pendulum can swing the other way. Um, but besides that, I really don't have too many thoughts on Japan from a macro perspective. I just know when I study individual companies, I'm impressed with what I see. I find some entrepreneurial companies, some innovative companies there, um, mixed with some low valuations. Where when those two things are combined, you can get some really great results. And I know India is a country too with an explosion of entrepreneurship and some really great talent and really great companies there too. So I guess that's what you really like to see from your countries. I think it's a good sign for the future.
Yeah, interesting. India is in a very interesting space to be. One of the most priciest market in the world, but people love it. Though the foreign institutional investors lately have been selling, but the domestic capital is so much. It's almost more than $2 billion a month, which is coming from domestic capital, from the retail money which is flowing in the country, and which is making sure that the stocks are not falling. And we don't have to be dependent on international money anymore. So I think that's a good part and the good development which has happened in the last 4 or 5 years. People have become very, very active. And I think we're going back to what US was in the 1960s and 70s. And I think that phase has been seen in India. So let's see how it goes. But then I think all the good areas have been taken in a positive way. And I hope things remain like that for India in the coming years. So, Jacob, you meet with a lot of wealthy families in America. And can you share some perspectives of how do they think? What is their perspective when it comes to investing, stock picking, or targeted return? Or what's their common questions when you pitch to them with regards to your strategy? Any thoughts?
Yeah. I would say I know when I pitch my strategy, a lot of people like to see a nice long track record of returns, which I'm still building um, or attempting to build. But so I'm not sure I'm the best person to ask for how family offices think. But if I had to guess or generalize, I think a lot of family offices focus on diversification, and diversification can be good. But um, if I was advising a family office, I think a family office is set up, you'd assume because there's some wealth involved, and I would just say, um, where an entrepreneur creates wealth, you would think that person has a advantage in that one area. Let's say someone made a fortune in real estate, the person probably has above average expertise in real estate, and so when you diversify, that can be it can be okay to take some money out of real estate and diversify a little bit, but I think you can go too far in the other direction where if you're an expert in real estate, um, you want to use that expertise to your advantage, and continue staying in your circle of competence, staying where your expertise is. Um, and I think someone like Charlie Munger, he would talk about how he had all his money in old age and three or four types of investments, and that gave him plenty of diversification. And so, um, you know, you might not want if you back to the real estate example, you might not want 100% of your family's net worth in real estate forever in case there's some crisis there, but you might not need 100 different investments, or you don't need to be in every single sector or every single geography. Um, I would probably want to nudge family offices a little bit to be a little more concentrated and focus on, where was your wealth built and what kind of expertise do you have. Encourage them maybe to not give that up, give that away.
Yeah, yeah. Very interesting point. I think it's even when we talk to a lot of family offices, I think uh, one is the perspective of the management. How do they think? The second is, I think we often see that people want to know that if they have a large sum of wealth, how, how, how do they make sure that they don't lose more than 15-20% of the capital at any point of time? That's where the asset allocation becomes very relevant. Some companies or some families, we see that they are very, very focused on preservation of capital, and some of them are very focused on optimization of capital. So in India, from anywhere from 10 to 20%, there are different kind of people who look at targeted returns. Is it the same what you feel in US? Uh, the targeted returns?
Yeah, that's you bring up some good points there too, and I think for each investor or each family office, it's good to know the personalities involved as well as the goals involved, because for some people, a 10 to 15% drop in your net worth, some people, that wouldn't bother someone like Charlie Munger, but other people, it might cause them a few sleepless nights, and they might really stress about that. So, you really got to know the personality involved. Knowing yourself is very important, and I think for me at least, I'm not worried by volatility and the way you can fight back against volatility, in my opinion, is to embrace volatility, not try to avoid it. Expect that you're going to have time periods where your net worth is going to drop by quite a bit. Instead, focusing on structuring your life where that's okay, whether that means making sure your expenses don't get too high, making sure you don't have too much leverage, making sure um, if you have outside investors, making sure they're the right investors for that, for a volatile portfolio, making sure they believe in you and all that. I think spending more time focusing on the structure, how you structure your life or your investment firm or your family office, as opposed to trying to avoid volatility, because I think it's very difficult. Maybe there's some people out there who are experts and can um, achieve avoiding that volatility, but it's very difficult, even for investments and companies that appear safe. You might think you're taking a conservative route, or you might diversify a lot, but during some major global crisis, every type of asset could go down. You might not have one perfectly safe investment option that's also going to achieve a decent return. And so I think it's very difficult to avoid volatility, and instead focusing on how can you structure yourself in your life to get through it.
That's a very, very important point, and makes me remember of what I think Ray Dalio said, that because he runs a multi-asset fund, multi-asset, multi-geography, that in your lifetime, assuming you are going to live for 70, 80 years, every single asset class is going to fall by more than 50% in terms of value. Even if you are staying in a real estate whose prices don't get measured every day because it's not on the screen, if you have a flat 6-7 years with an interest rate of 4 to 5%, effectively you lose 50% of your value. That's happened in India in 2013 to 2020. Real estate didn't go up in value, and the interest rates over here are 8.5%. So practically you lost a lot of your wealth, which you didn't even realize, because you are practically not seeing the prices on a daily basis, and it's not giving you a heart attack. But then I think the best way I feel is, so I feel that asset allocation is important. Yes, everybody doesn't have a skill set to do it properly, but the only way you can manage volatility to an extent, of course, you have to embrace it. You can't run away from it if you are living life. I mean, life is always like this, and the markets are also like this. But then the only way you can reduce it slightly by having assets which have least correlations, and those correlations also break. And you have to embrace volatility. Like in 2008, we had the fixed income and equities both going down together. Even though you had fixed income and equity, you lost more than 50-60% of the capital. So you have to embrace volatility. Point taken. I think it's more important to change our mindset towards volatility rather than running away from it. You just can't run away from volatility. That's part of life. That's a part of your assets. That's a very interesting takeaway, I think. Jacob, thanks for sharing that.
You're welcome. Yeah, and there's a great investor, Lee Lu. In an interview, I believe he said once, he joked that it seems every 5, maybe 10 years, there's a once in a century crisis. When he started in the mid 90s, maybe there was the Asian financial crisis. Then early 2000s, you had the tech bubble. 2008, 2009 was a financial crisis, and then COVID, and more recently. And each time there might be some headlines where it's a once in a century problem, but a different once in a century problem seems to appear quite often. So you really, studying history just kind of helps cement into your mind that you just have to be ready. You can't avoid it, and you have to be ready for those, for a crisis to emerge.
Yeah, and I think the way I think a lot of investors have started thinking, and that's one of the ways even we think, is that you should always have cash available, at least 15-20% money available, even if it's a cash drag. And every 5 or 6 years in this environment, which earlier used to be around 10 years, now every 5-6 years, there's going to be a big opportunity in one of the asset classes. So it could be in commodities. Maybe commodities have not moved, and maybe we see a dip in commodities, and then you load that commodities in your portfolio. Or it could be in small caps. Maybe in US, it could be the small caps. The next wave up. The large caps are so much bloated and so highly valued that, but it it doesn't fall. Uh, so I think that opportunity comes every 4 or 5 years. So if you have cash and you see real deep value, maybe this time it could be China. We don't know. China is real deep value. But I think maneuvering the levers whenever something goes extremely down, a three standard deviation movement maybe, I think it's a great opportunity.
Mhm.
Hmm? That's the way we think at IFA, that whenever that opportunity comes, load up, because the element of risk in that asset class is not the same when it is 60-70% down.
Mhm.
So if you're buying small cap at a PE, which is fairly valued, versus a small cap which is 50% of the value, like currently in US, then probably the risk is not the same.
Mhm.
And the margin of safety is towards your favor. That's what we feel.
Yeah.
Any thoughts on this?
Yeah, you mentioned, some investors keeping more and more cash on hand, and what it made me think of is, in my book, one thing that really was hammered home to me was that Berkshire, the way it was structured to be very safe, to survive many, many decades, and it was structured so that it could take advantage during a tough time. And so what I mean by that is there was never a period where Berkshire took on too much debt, but also it had major insurance operations, and the insurance companies operated with quite a bit of capital, more capital than an average insurance company would. And so, especially when you look at the revenue the insurance companies had, the premiums they generated compared to capital. And so any way you sliced it, um, Berkshire, it was safe. Berkshire was diverse in terms of it was in a lot of different industries, its subsidiaries. It had stocks that, had some liquidity they could sell if they needed cash. They also kept some cash on hand, low leverage. And so there was just layers of safety, I'd assume, earnings coming in, also liquidity, also, I guess, low leverage. So there was never a single point in time throughout all those decades where an outsider would worry if Berkshire was going to survive. There was no Berkshire Hathaway never flirted even closely with bankruptcy. And there's a lot of great companies that had near death experiences. There's a lot of great companies that happen to survive that are, good today, but there's plenty of business stories of near death experiences for even the great companies. Berkshire is one that there's no point any point in time when I study it, there's not any time where I would worry about their survival. So they were structured that way by plan. They could have been more aggressive and got slightly higher returns per year, um, which would be meaningful in terms of dollars today, but they didn't want to risk that. So I think any investor, that's what I was talking about earlier about structuring your life too. It's sometimes slightly lowering your rate of return expectation and making sure you have um, some safety, one to survive, but two to take advantage during the tough times.
Yeah, yeah, very valid point, I think. But what I've also seen is that the people behind the company, it matters a lot, because at one end you have a person known as Elon Musk who likes to flirt with risk every single day. His definition of risk is very, very different as compared to what Mr. Buffett thinks or Mr. Charlie Munger thinks. Even he's done a pretty good job, but these guys have also done a phenomenal job across decades. And I think uh, when we meet investors or people running companies, I think their psychology, their perception of risk, their way of doing business, obviously both get celebrated in their own way. But I think the styles of running businesses are very, very different
Mhm.
for both of them.
That's a great point. And I do have a lot of respect for Elon Musk today because there were points where they were very close to death in the early days. I think in some of his biographies, they talk about they were within days of going
Yeah,
under,
yeah,
maybe in the mid to late 2000s. I can't remember the exact time frame. So he put his wealth on the line and nearly lost a lot of it at times. And So you respect someone who takes that much risk, because it could have ended differently for him. But I think consumers are happy that Tesla and his other company survived, and it's nice. I don't want to take quite that much risk myself, but I'm happy someone else does it for us.
In fact, I would say the kind of investors Tesla has, they're also the kind of people who likes to flirt with risk around. I am personally invested in Berkshire, but I am not invested in Tesla. Uh, for my passive part of the portfolio, I would like a Berkshire because I just feel it's a passive fund that I've invested, which is going to compound at 10, 12, 15%, depending on what nature the market is. But when I talk about Tesla, probably, yes, it's a futuristic leader, but somehow I don't like the valuations at $220. So I would not like to be there. But there are people who have put in all the life savings in Tesla, and they're believing that probably this is going to be the new uh, Nvidia or the new Microsoft, which is going to sustain for 30, 40, 50 years. You know,
And it is important to attract the shareholders that are right for your company. I know Buffett's talked about that. I think Jeff Bezos has quoted him quite a few times on that. Story about you can hold a rock concert and that's fine, or you can hold an opera, but you just want to make sure you're advertising it correctly, where the rock fans go to the rock concert and opera fan goes to the right concert. And so I think both Berkshire and maybe Tesla have done a good job of making sure they're very clearly communicated maybe the strategy, and I think shareholders can self-select into what's right for them. And I think those are two good examples of you might get the right. If you switch shareholder bases, Berkshire shareholders switch companies, I think it'd be a disaster. But I think how it is now, I think both companies got shareholders that maybe fit for the structure and the philosophy of the companies.
correct, correct, correct. Right. So, Jacob, if you have to build, I understand that you specialize in picking stocks, and if you have to make a model portfolio of, and since you specialize in undervalued stock, I will raise the bar and make it 20% instead of 15. 15 is a benchmark in India because 12 is nominal. People look at 2-3% extra alpha. Since you're picking undervalued stock, if you have to maintain a 50-20% CAGR return, what would be your style? Can you just take us through the method? Uh, what would be your style?
Um, this answer might be cheating here, but if I had to achieve 15 to 20% returns, what I would first try to do is lower expectations for everyone. I would try to avoid that. I would want to set lower expectations to maybe even below 10%, at least for an expectation. And if someone can achieve more than that, that's great. But one thing I worry about, I've heard Charlie Munger talk quite a bit about this, is in the US and a lot of countries around the world, it's been a really great 50 to 100 years. Um, in one of the last interviews Mr. Munger did before he unfortunately passed away, he talked about in the late 1800s, early 1900s, I think it was in the 1800s, very wealthy people in England, it was very common for them to aim for returns of 1 or 2%. I believe he said very, very low returns. That's what they expected. That's what they aimed for. Um, so if you look at the history of the world, um, the last 50 or 100 years are an extreme outlier. And so just because we've lived through that, I think a lot of people start to expect that's like a right. That's like a given that we all deserve very high returns. There's there's thousands of year periods in the world where there was no growth at all, and then there's so I guess this world of S&P index fund safely going up 10% per year like clockwork. That's a very new phenomenon, and although I'm optimistic in the future for sure, I think things will be great. I just think sometimes it's unsafe to just expect that it's a given right, that things are bound to go up all the time. And so there just can be short periods, medium periods where you have a lost decade. Japan suffered that, where things got so hot that you have 10 years where it takes time to recover. I'm not warning any. I'm not a doomsday person. I'm very optimistic on the future. I just think it's safer to lower expectations. And because I think people get into trouble if they assume um, assume too high of expectations, because then you start to take a little more risk than maybe you should, and all that. But with that being said, the strategy I would go about trying to achieve great returns is what I said earlier, of flipping A to Z, trying to be very patient with what you do invest in, but being incredibly aggressive in your search for companies. It's a weird balance of aggressiveness and constantly searching and studying versus, and then patience in buying. And then if you truly want very high returns as well, you have to concentrate in a low number, because there's not an infinite number of great opportunities. So you have to concentrate. The thing that brings on, though, is volatility. And so it's all trade-offs. If you want to aim for higher returns, you have to concentrate and then suffer through volatile times and bigger drawdowns in the bad years if you're going to want bigger returns in the good years. And so for some people, maybe they feel better having a more diverse portfolio that does not have as high of returns. And so maybe that's not the most fun answer, but that's how I think of things. I try to set expectations low. If you can exceed them, that's great. But and then yeah, that's what I'm trying to do is that's the whole reason I'm very concentrated, is to I accept volatility. It doesn't make me go through sleepless nights, but it's not for everybody.
Yeah, yeah. And what's the kind of number of stocks you keep in your portfolio?
Right now, we own 9 stocks, so anywhere from like 8 to 12 feels right, but it really depends on what opportunities I see out there, um, and if you're finding maybe more and more opportunities, you can expand the portfolio a little bit there. But it's a balancing act of each time you find a new idea you're interested in, weighing it against what you currently own and weighing it against all the other opportunities you see out there. Um, so it's not one exact number for me, but it could vary over time. But right now, we own 9 stocks.
Excellent, excellent, excellent. So, uh, two of your favorite books?
I love biographies. Um, I love because you pick up little nuggets on both the entrepreneur and the business itself. One I read recently, um, I've heard Charlie Munger talk quite a bit about the National Cash Register Company. It
Yeah,
was a company formed in like the very late 1800s, early 1900s. In Poor Charlie's Almanac, if you read that book, he talks about
yeah,
National Cash Register in there. And so I was reading the annual reports from the early 1900s of the company, and then I didn't realize it, but there was basically a biography on the founder out there, I think written in the 1920s. And so I just kind of stumbled upon the book, didn't have too high expectations, but I really loved the life story of that founder. Kind of a slow start in life, and just kept pushing through different entrepreneurial ventures. Eventually, stumbled on the cash register and built a really impressive business. And um, National Cash Register (NCR) still exists in one form or another today. There's an NCR corporation that's a billion-dollar company today, and there's been some mergers and acquisitions. So it's been um, it might not be apples to apples with the original company, but it's still, there's businesses that survive today from that original founder. So that was one book. Um, um, Patterson was the last name of the founder. I can't remember the name of the book, but a biography on him from National Cash Register was one of my favorites. You said 2 books. So besides that, um, I love a lot of other biographies of the famous founders, but maybe a different style of book. Nassim Taleb has written some awesome books, from Anti-Fragile, Fooled by Randomness, or The Black Swan.
yeah,
Um, any one of his books would be up there with some of my favorites too. He's a unique thinker. He makes a lot of points relevant to investing, but a lot of his books, are relevant to even people outside the investing world too. So
yeah, yeah. I think that's one of the very good books written, Fooled by Randomness. And as the entire series, his thought process of thinking is very, very interesting. And I think any investor, as you were rightly saying, that who expects a 10%, 15% CAGR return in S&P should actually read this to understand things are pretty random in life and everything is a probability. There's no uncertainty, there's no certainty. Especially I see
Exactly.
people who are uh, who've been very lucky with investing in the last 7, 8 years. They practically have not seen any bear market, whether it's been United States or whether it's been India. Two of the markets which have been a steady uptrend for a very, very long time. I think after 2009, we didn't see a bear market in America, and same in India. Even if it had drawdowns, but it hardly stuck on for 6, 8, 12 months. So I think these books are very relevant to understand and lower investor expectations. So I think the note of the changing world by Howard Marks was also indicating on the same lines. The world is going to be different with higher interest rates and possibly lower equity returns going forward. And lastly, I asked this question to everyone that how did you develop spiritually? Investing is very difficult. Uh, Getting investors are very difficult. And reading balance sheets in isolation is very lonely. How did you evolve spiritually over the period?
Yeah, I would say I'm still evolving spiritually. I guess it's always a ongoing process. And I feel like this answer for me would have changed quite a bit in the last year or two. And um, one thing, Nassim Taleb, he talks about the Lindy effect. And my understanding of that term is that time is a great filter, which means books that have been around thousands of years, there's maybe a reason they survive. There's some sort of wisdom you could take from it. It might not be um, completely obvious on the surface what is important to take from those books. Especially nowadays, maybe it's harder for us to get into the mindset of what those people were going through back then. Could be translation issues or whatever, but there's probably a reason a book survived. If a book was bad with no real wisdom to take from it, it probably wasn't going to survive thousands of years. So I love history. I've lately come into a greater appreciation to read books that were written a long time ago. I happen to be a Christian, which to me means a follower of Jesus Christ. And lately I've been reading older, the Old Testament, some of the older books in the Bible. And when I first would read them, I didn't really understand and didn't really have a good appreciation. Lately, more and more, I'm finding there's some wisdom in the books that are very old, and maybe it just takes more work analyzing them and understanding. And that goes for not just for the Bible, but any book written a long time ago that survived. I think it's pretty interesting to see if you can find some wisdom there. And the reason I bring that up is because today I feel like it's more and more difficult to do that. Society seems to be going the opposite direction of social media and the internet. There's so much new things coming your way all the time. It's very hard mentally um, to put that down and to stop scrolling on the screen. It's hard to kind of pick up an old book, something that's been written a long time ago. But I really enjoy it. It brings me comfort. Any difficulty economically or personally you're going through, someone's gone through that in the past, so history helps with that. And especially for a young person, like you said, 7 or 8 years of the market's going up. That feels like a long time. 7, 8 years feels like maybe a proven track record for an investor, maybe. But when you look at history, if the market's been going up 7 or 8 years, it's pretty easy if you look at history to get yourself in the mindset of, okay, it's not going to last forever. There's going to be some ups and downs over time. So that's maybe the one message I would go. The Lindy effect. Read things that have been around for a long time.
I agree. I agree with you completely. I think whenever I interview the young people today, I ask them, what do you read? And most of the time, they tell me about some very popular podcasts, random stuff on Twitter and internet. But very few people actually pick up books which are classics.
Mm-hmm.
You know, books like Man's Search for a Meaning, or what Ray Dalio says, look at history. and you learn so much from history. But nobody looks at that because it's not exciting. If you want to pick up a stock, then the chat rooms and Twitter gives you enough information, but then nobody wants to do the difficult job of reading hardcore balance sheets and spending a day or two. So I
Yeah.
think I always tell this to my daughter. I say, and she's a big fan of reading books, and I say that make a list of 100 books who are classics and have stayed for 70, 80, 90 years. The Lindy effect, what you're talking about. And if they've stayed and still it's the best-selling book on Amazon, that means it carries a lot of value. So let's pick them first, and then probably the next best selling book on top. I think that would be the right chronology. But then, of course, different people think differently. But I would agree with you that picking up the classics makes a lot of sense.
And
You
there's so
know,
many to choose from, and you could spend years and you could spend a lifetime going through them. And I suspect over time you'd find a lot. There's a lot that rhymes between a lot of the great books over time. There's um, a lot of books that might not have tried to copy off anyone else, but there's just a lot of the wisdom seems to rhyme between some of these books too. So
correct, correct. In fact, the new books are just the older books told in a different way, which can relate with the audience with an element of branding. But I mean, uh, Graham will be always there for the next 100 years, also probably. The wisdom doesn't change. Uh, so I think it's a great strategy to look at the older books which have stayed in time.
mhm.
Yeah.
Agreed, 100%.
Anything else you would like to share with the listeners?
No, that's it for me. I really appreciate you taking the time, and I've enjoyed the conversation.
Oh, I thoroughly enjoyed that. Such a candid conversation with you, your style of investing, and it's a it's really good to talk to you today. I think I thoroughly enjoyed talking to you.
That.
Lovely, lovely talking to you, and thank you so much for spending time with us.